Ladies and gentlemen, good day and welcome to the Jubilant Ingrevia Ltd's Q4 and FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pavleen Taneja, Head of Investor Relations, Jubilant Ingrevia Ltd. Thank you, and over to you, Mr. Taneja.
Thank you, Robin. Good evening, everyone. Thank you for being with us on our Q4 and financial year 2024 earnings conference call of Jubilant Ingrevia Ltd. I would like to remind you that some of the statements made on the call today could be forward-looking in nature, and a detailed disclaimer in this regard has been included in the press release and result presentation that has been shared on our website. On the call today, we have Mr. Shyam Bhartia, Chairman, Mr. Deepak Jain, CEO and Managing Director, Mr. Prakash Chandra Bisht, CFO, Jubilant Ingrevia, Mr. Arvind Chokani, Group CFO, Jubilant Bhartia Group. I now invite Mr. Shyam Bhartia to share his comments. Over to you, sir.
Thank you, Pavleen. A very good evening to everyone. Thank you for joining us on Q4 and financial year 2024 earnings conference call of Jubilant Ingrevia Ltd. We are pleased to announce stable business performance for Q4 amidst the continued challenging market conditions. We are also glad to share that the board has recommended a final dividend of 250%, that is 2.5 per equity share of face value of rupees 1 each for the year FY 2024. This shall result in cash outflow of 39.8 crores. During the year, the company has already declared an interim dividend of 250%, that is 2.5 per equity share of rupees 1 each, and the total dividend for FY24 works out to 500%, that is 5 rupees per equity share of rupees 1 each, amounting to 79.6 crores of cash outflow. We are pleased to share that during the quarter, we have commissioned our multipurpose agroactive intermediate plant capacity in Bharuch facility. This would strengthen our capacity and capability to produce forward integrated high potential agroactives and intermediates. In addition to that, we have also commissioned a plant for new diketene derivatives in Gajraula factory, which will further enhance our diketene product portfolio. Commissioning of these plants is in line with our strategy to further strengthening our specialty chemicals product portfolio through long-term contractual arrangements with our customers. The agrochemical sector, which faced dual challenge of overstocking of inventories and oversupply from China during the year, is yet to bounce back to normalcy. While the excess inventory situation is expected to ease out and volumes are likely to move, the prices may still remain under pressure due to excess supply of agrochemicals globally. We expect this sector may still take 1 or 2 more quarters to recover fully and get back to normal. In the pharmaceutical end-use segment, we witnessed stable demand trends with healthy volumes placements during the quarter. Early signs of further improvement in demand in certain products are signaling near-term outlook remaining buoyant, with significant price recovery yet to take place. In nutrition segment, the demand is steady. However, the prices remain under pressure on excess supplies from China. With the onset of new financial year FY25, we expect all 3 segments to improve sequentially over FY24. Our key focus in FY25 will be on customer centricity, ramping up newly commissioned plants, remaining lean, and bringing back the margins to normal levels. We are firm on track towards investing in high-potential product categories and expand our product portfolio through our ongoing modular CapEx plan of rupees 2,000 crores to deliver structured growth and drive us towards our newly created vision of Pinnacle 345, that is 3 times revenue, 4 times EBITDA in 5 years. With this, I now hand over to Deepak to discuss about the business in detail.
Thank you, Mr. Bhatia. A very good evening to all of you. At the outset, I would like to thank you all for joining us today for Q4 and FY24 investor call of Jubilant Ingrevia Ltd. Let me now take you through the overall business and financial performance along with key highlights of the company for the fourth quarter of FY24. At an overall level, the previous quarter was yet again a challenging quarter for global and Indian chemicals industry, primarily driven by muted demand in key end-use segments such as agrochemicals, along with persistent pricing pressure across the segments. Despite the above challenges, we could keep our financial performance largely stable versus previous quarter, driven by our continuous customer engagement and multiple cost savings initiatives. In specialty chemicals, we witnessed higher volumes coming from pyridine building blocks and fine chemicals, including diketene, wherein CDMO remained the key driver for our future growth. In nutrition and health solutions, we witnessed higher sales volume coming from niacinamide, wherein pricing remained muted. In chemical intermediate business segment, acetic anhydride volume was stable, while the pricing remained soft on account of lower demand from paracetamol and agrochemical end use in both India and European markets. During the quarter, we were also impacted due to higher freight costs led by Red Sea crisis, which correspondingly dented our overall margins. With the help of our Project Lean initiatives, we successfully kept our costs under control and brought our working capital down to 18% of sales through focused inventory optimization and other measures. We have also signed an agreement with O2 Renewables for captive renewable energy sourcing for our Gajraula and Savli facility. We expect the share of renewables to increase to 30% plus in next 12 to 15 months. Under our digital initiatives focused on productivity, yield and energy cost optimization through digital search program, we have completed multiple projects to bring efficiency across the manufacturing locations. Our committed capex plan stayed on track. During the last quarter, we commissioned our multipurpose agroactive and intermediate plant at Bharuch facility. In addition to that, we also commissioned a plant for new diketene derivatives in Gajraula facility. Our GMP compliant facility for food and cosmetic grade vitamin B3 is expected to be commissioned in Q3 FY25. Our capex execution track record demonstrates our commitment and strategy to structurally expand and shift our business mix towards value-added specialty intermediates. This is also visible in specialty and nutrition share of revenue continuing its upward traction at 60% in Q4 FY24 compared to 54% in Q3 FY24. We are also under process of devising our further expansion plans for coming years in light of numerous opportunities where we are seeing increased and accelerated traction from our customers. Now let me take you through the updates on all of our 3 business segments individually. Starting with specialty chemicals, during the quarter, the specialty chemical segment grew by 30% quarter on quarter and also saw marginal growth versus last year. We witnessed continued improvement in demand from pharma end-use segments, wherein volumes remain strong and prices are yet to recover. Whereas in agrochemical end-use segment, destocking phenomenon is expected to be at a fag end. However, we are witnessing volumes growing gradually. Agrochemical oversupply from China is still a concern, which is keeping the prices muted. Driven by fine chemicals and CDMO, demand from North American and Europe region grew during the quarter, while domestic market was relatively soft. Our diketene plant is currently operating at 60 to 70% utilization, wherein we witnessed sizable volume traction during the quarter. In CDMO, we continue to have a high visibility on future growth pipeline. We are in advanced stages of discussions to close a few long-term contracts across agro and pharma sectors. We also continue to see new inquiries in semiconductors and electronic chemicals too. Our microbial control solutions business is witnessing a good momentum through new products launched in Pyrethrom's platform. This will support accelerated growth going forward. As mentioned earlier, during the quarter, we also commissioned our multipurpose agroactives and intermediates plant in Bharuch and diketene and derivatives plant in Gachola. Now moving on to the nutrition and health solution business segment. During the quarter, the nutrition business grew both on quarter-on-quarter and year-on-year basis, largely driven by higher volumes. Vitamin demand remained stable, though competitive pressure was witnessed across the product range. Our view is that customers seems to be in a buying mode now, but unwilling to accept higher pricing. Despite that, we could increase our global market share in vitamin B3 in FY24. We also launched new product range in the segment with introduction of liquid choline chloride and choline bitrate. We also witnessed volume for food and cosmetic grade registering significant growth in Q4 FY24 sequentially and in FY24. I would also like to share that our GMP compliant facility for food and cosmetic grade niacinamide is expected to be commissioned in Q3 FY25, for which we have also started receiving good traction towards volume booking. The decline in segmental EBITDA was warranted mainly due to benign pricing led by Chinese competition. Now let me throw some light on our chemical intermediate business as well. Revenue for the quarter and the year were impacted on account of lower prices of acetic anhydride, which were primarily driven by lower demand from end-use industries and lower price of underlying key raw material, that is acetic acid. During the year, continued lower utilizations in downstream industries, including agrochemicals and paracetamol, constrained further volume pickup in the segment. During the quarter, Red Sea challenges also resulted in overall increase in ocean freight, which impacted our sales and margins during the quarter. We continued to maintain our dominant market share for acetic anhydride in domestic markets while increased our share in European markets. We also implemented world-class digital initiatives at our global manufacturing facilities to improve our operational efficiencies in the business segment. During the quarter gone by, we received 99% plus biogenic content rating for green acetic acid. This achievement would enable us to push our sales with global food giants in coming years. Now let us discuss the overall financials of the company. The overall revenue during the quarter stood at rupees 1,074 crore as against rupees 966 crore in Q3 FY24. The revenue was higher mainly due to higher volumes coming from specialty chemicals and nutrition segments. The revenue for FY24 was rupees 4,136 crore against a revenue of 4,773 crore in FY23. The EBITDA for the quarter stood at rupees 101 crore as against rupees 104 crore in Q3 FY24. EBITDA was almost flat, mainly on account of benign pricing in nutrition segment led by Chinese competition and also lower realization in acetic anhydride. The EBITDA for FY24 was rupees 456 crore against an EBITDA of rupees 580 crore in FY23. The capital expenditure incurred during the quarter was rupees 143 crore and for the FY 2024 it was rupees 572 crores. We expect to spend the remaining approximately one-third of originally announced capex of rupees 2,000 crore in FY25, which will mainly be incurred towards food and cosmetic grade niacinamide plant, new food grade choline plant and expansion of GMP facilities. The net debt of the company as on 31st March 2024 was rupees 653 crore and net debt to EBITDA ratio was at 1.43 times. The increase of rupees 341 crore in net debt during the FY24 is led by rupees 572 crore of capex. Despite high capex, we restricted borrowings and actually decreased the net debt by rupees 48 crore during the second half of financial year through focused working capital optimization led by active management of inventories and other measures driven by lean initiatives. Net working capital percentage to turnover for Q4 FY24 was sequentially lower at 18%. During the quarter, we opted to move to the new tax regime from FY24 onwards, whereby the applicable statutory tax rate shall only be 25.17% as against the statutory tax rate of 34.94% in the old tax regime. However, the tax expense for the quarter and the year includes a one-time transitional write-off of opening brought forward MAT credit amounting to rupees 12.56 crores. The expected ETR from FY25 onwards will be in the range of 25 to 26%. The PAT for the quarter was rupees 29 crore after adjusting for MAT credit write-off, as against rupees 39 crore in Q3 FY24, while the PAT for FY24 was rupees 183 crore against a PAT of 308 crore in FY23. As we move forward, I would also like to share an update on a few strategic initiatives undertaken in recent times. As I mentioned in the previous quarter, the leadership team of Jubilant Ingrevia has designed a bold 5-year growth strategy. We have set out a new growth roadmap for ourselves called Pinnacle 345, that is 3x revenue growth, 4x EBITDA growth in 5 years. Over the last few months, we did a bottom-up assessment of each of our businesses and product platforms and crafted a detailed strategy for each business. The Pinnacle 345 growth roadmap is deeply rooted in our core strengths, i.e. customer centricity, world-class operations, innovation, ESG leadership, and people focus. It also leverages the opportunity that is coming into Indian chemicals industry on the back of 5 mega trends, namely supply chain diversification, domestic demand scale-up, value-added products acceleration, digitization, and ESG focus. You can find more details on Pinnacle 345 and our BU-wise priorities in our latest investor presentation. We have already started the execution of this strategy across our BUs and have also created a program management office to ensure a rigorous tracking mechanism. Over the coming quarters, we will continue to share more updates on Pinnacle 345, and hopefully you will also start to see its impact on various aspects of our business, including new customer partnerships, new capex, and several other new initiatives in coming quarters. With this, I would like to conclude our opening remarks. We'll now be happy to address any questions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to please use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Jinal Sheth from Auriga Capital Advisors. Please go ahead.
Good evening. Am I audible?
Jinal, please go ahead.
Yes. Thank you for the elaborative and detailed inputs and of the business. Just wanted to catch your point that obviously the new capacity has come on stream, and what you also mentioned is that we're currently operating at 60-70% utilization. Just wanted your thoughts on the fact that currently we are at our demand environment is a bit uncertain. So is this something that is come from our customer base that we've kind of expanded to that extent? So some thoughts out here would be useful.
Yeah, Jinal, you are absolutely right. We, as we spoke in the previous calls as well, we have invested heavily in the last 2 years and created new capacity in our businesses such as diketene, acetic anhydride, agrochemicals, etc. And because these are new product lines, except for acetic anhydride, which we have been doing for almost 4 decades, in most of these situations, we have found new customers we are selling these products to. And across these plants, the capacity utilization is already touching almost 60% plus, even in this environment. And as I mentioned in my opening remarks, as we get more volume traction, we are seeing that capacity utilization is only increasing month-on-month and quarter-on-quarter.
Okay. And secondly, is it true that the inventory correction, are we seeing that in China as well, where capacities are probably going off? Any comments on that?
Those are two different points, Jinal. From the destocking perspective, as I mentioned in the past and even today, and we are seeing that in our business as well as hearing it from all our customers, the destocking seems to be at the fag end after last 18 months or last 18 painful months. From a supply perspective, China, of course, at least in agrochemicals, from whatever we understand, has created a lot of capacity, and we still think there is excess capacity there.
Okay. Just lastly, a connected question to the first question that I raised was that in regards to the capacity expansion, that would that kind of lead to, say, a suboptimal returns given the demand environment? And obviously, consider the way to put it is the pricing is not optimal at this stage. Is that a fair way to see that?
Yeah. So I think, for the areas where we have put up capacity, most of those are, number one, specialty areas, high margin products. Number two, these are products, if you look at our business mix, only 20% of our business, 20-25% of our business is linked to agrochemicals. The remaining 70-75% business is in pharma, in cosmetics, in nutrition. We are getting good volume traction as the numbers also tell. If you look at our business by BUs, the volumes which are coming from there are helping us improve the capacity utilization. Of course, there is pricing pressure in some product lines, but I don't think that will change our overall return profile. If you look at it from a multi-year perspective, of course, a few quarters pressure will remain, but at least from the overall recovery value as well as returns from those assets where we have invested, we still stay bullish, and we think the NPV or the IRR of those products on a multi-year basis will be at par with what we had projected.
Thank you so much, Deepak. Good luck to the team.
Thank you.
Thank you. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, sir, thanks for the opportunity. One question in terms of the different segments and product lines that we have. So what has been the comparative scenario from China? Because as you had also mentioned in your opening remarks that there has been a competition. So which are all areas where we are seeing that the competition is coming, and which are all area where we will still have pricing power once the normalcy returns from the inventory destocking and the other global phenomena which are affecting the business? Thank you.
Yeah, Rohit, I'll just add to what I said in response to Jinal's question. Most of the pressure is in the agrochemical segment. Obviously, there is competition in nutrition and pharma segments as well from China, but the level of pressure there is not as acute as it is in agrochemicals. Just as an example, in some of the agrochemical product lines, not just for us, but if you track the import data, the broader decline in pricing has been up to the 30, 40, 50% also. While if I take example of vitamin B3, which is one of our core products in the nutrition segment, the pricing has been flat for last 5 or 6 months, and there is only marginal decline versus what it was previous to that. So the amount of pressure varies significantly by segment, as you rightly pointed out. It's more acute in agrochemicals, nutrition, and pharma are largely stable.
Having said that, China plus one strategy with large companies still valid, and we are seeing a lot of inquiries in some inquiries in the agrochemical intermediates, which are China plus one strategy, And as Deepak said that in the coming quarter we are going to conclude a large contract for agrochemical intermediate. This is related to China Plus One strategy, and a lot of inquiries still coming in. But since the China prices are so low, so people are trying to defer the inquiries. But this inquiry is very strong, and we are going to conclude this business, which is a large business. And secondly, we are receiving inquiries for agrochemical sector, but people are trying to defer those. But the strategy, after discussing with large agrochemical companies, still remains very active at China Plus One. But China being at such low prices, this is the wrong time to shift from China to India. But of course, that strategy, as in next 3-4 quarters, the China prices are going to go up, then definitely this strategy will come back to in action again.
Yeah, and to add to Chairman, I think for everyone's benefit, because I'm sure that question will come. Most of the discussions we are having with our customers, be it agro, pharma, or even let's say cosmetic space, particularly for the CDMO business, the customers are speaking to us despite whatever is happening to pricing and competition from China with a long-term view. And in many cases, they are helping us working with our R&D team to optimize the cost structure to ensure that we collectively are able to take on the competition on pricing and then optimize our cost accordingly. So couple of contracts that Chairman talked about are in line and with that kind of arrangement with the customers.
Sure, that's helpful in terms of elaborate answer. Just to put it slightly differently, out of the entire business, how much of the business is how much of businesses prices are governed by China or dictated by China? Given that if there are incremental capacities which have come up or which are coming up in China, will still have pricing pressure on those set of products or segments that we have.
So Rohit, I don't have the precise number, but what I can say, like if again I will go back to what I was saying earlier and talk sector by sector, and then we publish that information in our investor presentation also. Agrochemicals is roughly 20-25% of our business. Obviously, there is a huge pressure there from China. Pharma is roughly 30% of our business. The relative impact of China pricing is less there. And especially in our chemistries, be it diketene, pyridine, or some of the other products, we are able to command pricing. If I take nutrition as an example, vitamin D3, we are world number 2, and we and China are more or less at par. So any one of us can disturb the price, or any one of us can command premium as well. Right now, it's a deadlock where we are at a flat price, as I said, for last 6 months or so. So the answer varies significantly. It's not a 0-1 game that these are the products where China price does not impact. These are the price where it impacts. It varies significantly. There is obviously some impact when there is a competition from China, but the level of impact and implication of that are very different by segments.
But in niacinamide also, having said that, there is more competition in the animal sector, whereas in human and food sector, there are less competition, and we still get a price premium in that sector. And as Deepak mentioned about it, that is why we have set up this new plant where we can supply for cosmetic and for food and for sectors where the people are skeptical of importing products from China, and China doesn't offer such high quality material. So therefore we command a premium there. Recently also our in food sector where we are catering our niacinamide from our existing niacinamide plant, we get a premium from the what we supply to animal sector. The main competition is in the animal sector. and which, of course, we being the lowest cost producer, we have an advantage. Of course, you cannot charge a premium pricing. The only thing in the animal sector, but the food sector still we get a premium price.
Sure. That's really helpful, and thanks for the elaborate